Good day, everyone. Thank you for joining us. We are Civit Consultancy, and we're excited to present our corporate valuation analysis. In this presentation, we'll explore Philippine 7 Corporation, better known as 7-Eleven Philippines. Let us walk you through who 7-Eleven is, what it has achieved, and where it is headed. Let's get started. Our discussion will cover the following key points: company overview, business model canvas, key facts and figures, assumptions, forecasted financials, valuation computation, technical analysis, and conclusion. Let's begin with an overview of the company. 7-Eleven Philippines, operated by Philippine 7 Corporation, has been serving Filipinos since 1984. With over 4,000 stores nationwide, it follows a franchise model, generating revenue from retail sales, franchise fees, and supply chain operations. Strategically located and open 24/7, 7-Eleven offers more than just convenience. It integrates cashless payments, e-commerce services, and a wide range of essentials, including its signature Big Bite hot dogs, 7 fresh meals, and City Blends coffee. These innovations solidify its position as the go-to convenience store for Filipinos. 7-Eleven Philippines operates with a clear mission: to make daily life easier by providing modern convenience. Its vision is to be the best retailer of convenience for emerging markets. These guiding principles shape the company's strategy and decision-making, reinforcing its position as the preferred convenience store for Filipinos. The company's core values define its culture and business approach: teamwork, fostering an environment of synergy through active participation and mutual respect; integrity, upholding honesty and trustworthiness in all interactions with employees, customers, and business partners; reliability, delivering on commitments and ensuring consistent service; data-driven, making informed decisions based on data and insights; customer focus, prioritizing customer needs to enhance their experience. These values drive 7-Eleven Philippines' commitment to service, innovation, and growth. Let's take a look at how 7-Eleven has grown into the convenience store giant it is today in the Philippines. In 1982, the Philippine 7 Corporation, or PSC, was established. This was a crucial moment as PSC signed its master license to operate 7-Eleven stores in the country, paving the way for the brand expansion. Just 2 years later, in 1984, the very first 7-Eleven store in the Philippines opened its doors. It was located at the corner of EDSA and Camias in Quezon City, marking the official entry of the brand into the local market. By 1989, PSC had turned its first profit. This was a major achievement, proving the viability of the 7-Eleven business model in the country. At this point, there were only 9 stores in operation, but this success laid the foundation for rapid growth. Fast forward to 1998, 7-Eleven had grown to over 100 stores. This milestone was accompanied by another big step. The company launched its initial public offering, with shares priced at 4.4 pesos. This move allowed PSC to expand even further, bringing more convenience stores to Filipino communities. By 2012, PSC reached a historic moment: the opening of its 7-11th store in the Philippines. This showcased the brand's dominance and widespread presence in the country. From 2013 to 2024, 7-Eleven has been committed to expanding its store network across the country. They have integrated technology, including e-money services and digital payment options, to enhance customer convenience. Additionally, they have diversified their product offerings, strengthened their customer loyalty program, Click, and implemented sustainability initiatives such as the Going Green campaign. These efforts have contributed to improved customer experience, convenience, and competitiveness in the market. Now, looking ahead to 2025, 7-Eleven has set an ambitious goal of opening 500 new stores nationwide. To support this expansion, they have allocated a capital expenditure of 5 to 6 billion pesos. This strategic growth aims to further solidify their presence and make their services even more accessible across the country. From its humble beginnings in 1982, To becoming a nationwide leader in convenience retailing, 7-Eleven has continuously grown and evolved to meet the needs of Filipino consumers. With thousands of stores across the country, it remains a trusted brand for quick and easy shopping. Now, let's take a closer look at Philippine 7 Corporation's business model canvas, highlighting how the company delivers value to its customers and sustain its operations. 7-Eleven stands out by offering quick food and beverage service for on-the-go customers, convenient locations that are accessible 24/7, flexible payment methods including cashless transactions, no minimum order quantity allowing customers to buy only what they need, exclusive products such as Big Bite hot dogs, 7 Fresh meals, and City Blends coffee, mobile app integration making transactions seamless, innovative food offerings that cater to evolving customer preferences, and online ordering for added convenience. To build and maintain strong customer relationships, 7-Eleven leverages social media pages for engagement and real-time updates, loyalty programs like Click, rewarding repeat customers, feedback surveys to continuously improve service and offerings, community events that foster brand connection, and in-store experiences that prioritize convenience and customer satisfaction. 7-Eleven generates revenue through multiple streams, including sales of goods from its wide product selection, exclusivity contracts with suppliers and brands, service income from partnerships such as bill payments and e-commerce pickups, franchising fees enabling business expansion, and rental income from subleased store spaces and partnerships. This business model allows 7-Eleven to remain a leader in the convenience retail industry, adapting to changing customer needs while maintaining strong financial performance. Now let's take a quick look at 7-Eleven Philippines' financial position. The balance sheet provides a snapshot of the company's assets, liabilities, and equity, reflecting its overall financial health. And moving on, the income statement highlights 7-Eleven's financial performance over the years, showing its revenue, expenses, and profitability trends. 7-Eleven Philippines includes key financial ratios in its annual report to track its financial health. Now, let's go through the key trends. Liquidity ratios measure how well the company can meet short-term obligations. Current ratio steadily increased from 0.93 in 2019 to 1.29 in 2023, showing an improved ability to cover short-term liabilities. Quick ratio also rose from 0.59 in 2019 to 0.76 in 2023, reflecting stronger liquidity, though it slightly declined in 2021 before recovering. Financial leverage ratios indicate how much debt the company uses for financing. Debt ratio declined from 0.73 in 2019 to 0.68 in 2023, suggesting a gradual reduction in debt reliance. Debt-to-equity ratio peaked at 3.08 in 2021 before decreasing to 2.14 in 2023, signaling a shift toward a more balanced capital structure. Profitability ratios assess how efficiently the company generates profits. Operating margin showed an upward trend from 5.19% in 2019 to 6.45% in 2023, except for a dip in 2020 to 2021. Net profit margin followed a similar pattern, decreasing during 2020 to 2021, but ultimately increasing from 3.5% in 2019 to 4.46% in 2023. 7-Eleven Philippines has demonstrated improved liquidity, stronger profitability, and reduced financial leverage over time, positioning itself well for future growth. But it is important to note that the years 2020 and 2021 may be outliers due to external disruptions, so they may be excluded from forecasting assumptions. The Philippine retail market is projected to grow at a 7.56% CAGR from 2025 to 2030, positioning Philippine 7 Corporation within a strong expansion phase. This growth suggests rising consumer spending, increased retail demand, and opportunities for market expansion, especially in convenience store networks and digital retail integration. To stay competitive, Philippine 7 Corporation must capitalize on this momentum by enhancing store accessibility, adopting e-commerce strategies, and responding to evolving consumer preferences. Philippine 7 Corporation has expanded its store network by approximately 9% annually over the past 5 years, reaching 4,120 stores in 2024 with a target of 500 more locations. Based on this trajectory, we forecast continued expansion until 2028, reflecting strong market demand and PSC's aggressive growth strategy. This implies a sustained push for market penetration, operational scalability, and adaptation to evolving retail trends in the Philippines. The company's main income comes from contracts with customers, including merchandise sales, franchise income, and service income. Merchandise sales are generated from both company-owned and franchise stores, with company-owned stores projected using retail market growth and franchise sales based on store expansion. Here are the additional assumptions we applied in our forecasting. Using these assumptions, we have projected the forecasted balance sheet, income, and cash flow statement. These financials reflect expected growth in revenue, store expansion, and cost trends based on historical data and industry benchmarks. The current ratio starts at 1.03 in 2024 and gradually increases to 1.36 by 2028, indicating stronger financial stability. The quick ratio rises from 0.66 in 2024 to 1.02 in 2028, showing improved short-term financial health. The upward trend in both liquidity ratios signifies a strengthening financial position. This indicates that the company is becoming more capable of handling its short-term liabilities efficiently over time, ensuring financial stability. The debt ratio shows a declining trend from 0.75 in 2024 to 0.65 in 2028. Similarly, the debt-to-equity ratio also follows a downward trend, decreasing from 3.06 in 2024 to 1.83 in 2028. These trends suggest that the company is moving towards a more conservative financial structure, reducing its dependence on debt while strengthening its equity base. This shift enhances financial resilience and long-term sustainability. The operating margin starts at 6.02% in 2024 and declines gradually to 4.2% by 2028, indicating a slight decrease in operational efficiency. The net profit margin starts at 4.08% in 2024 and drops to 3.02% by 2028, suggesting a narrowing profitability trend. While profitability ratios have slightly decreased, the company remains profitable, with revenue and net income continuing to grow. This slight decline could be due to increasing operational costs or strategic investments in expansion. However, the company's ability to maintain strong revenue growth suggests that profitability remains stable and manageable. Overall, the company is in a strong position for the next 5 years. Strengthened liquidity, a more balanced financial structure, and sustained revenue growth indicate that the company is well positioned for future expansion. While profitability has slightly declined, ongoing growth and financial stability provide a solid foundation for long-term success. Based on the overall analysis, the majority of indicators suggest holding the stock, with only one indicator signaling a buying opportunity. Investors should proceed with caution and consider additional factors before making any trading decisions. We computed the weighted average cost of capital at 9.91%, derived from an after-tax cost of debt of 6.57% and an average cost of equity of 12.56%. The cost of equity was determined using two methods: the discounted cash flow method, which resulted in 18.59%, and the capital asset pricing model, which yielded 6.52%. Our free cash flow is presented here, reflecting the company's operating performance and ability to generate excess cash after covering expenses and capital investments. Using an equity beta of 0.106, we computed the forecasted weighted average cost of capital, which served as a key input in valuing the firm. Our analysis resulted in a firm valuation of 105 billion pesos, reflecting its financial strength and projected performance. Additionally, with an Altman Z-score indicating zero probability of financial distress, we arrived at an intrinsic market value per share of 126.57 pesos, laying the foundation for our final investment assessment. Focusing on our fundamental valuation, Philippine 7 Corporation is significantly undervalued, with an intrinsic value per share of 126.57 pesos, compared to its market price of 65.65 pesos as of January 31, 2025. This indicates that the stock is trading well below its true worth, presenting a strong investment opportunity. For investors, this undervaluation suggests substantial upside potential, making SEVN an attractive long-term buy. As the market corrects its pricing, those who invest now stand to gain from capital appreciation. Meanwhile, for stakeholders, including franchisees and business partners, SEVN's growth trajectory and financial strength signal continued expansion and business stability, reinforcing confidence in the company's strategic direction. With these factors in mind, we recommend a buy for SEVN shares, as its strong fundamentals and sustained market growth make it a valuable investment for those looking to maximize returns.